Gold hit $5,000 an ounce earlier this year. Then it lost $750 in a month. If you held a position through that, you felt it. If you were watching from the sidelines, you either felt vindicated or you felt like you missed something. Either way, here's the part that should give you pause. The week gold cracked through $4,500, central banks were still buying. Geopolitical risk was rising. The dollar wasn't surging. Nothing in the structural picture changed. So why did the price collapse? And more importantly, does the reason tell us anything useful about what comes next? That's what this is actually about. Not whether gold goes back to 5,000. Whether you understand what's driving this market well enough to think clearly about it. Those are different questions, and only one of them is worth your time. Let's start with why it fell. Because the correction didn't come out of nowhere. It had specific, identifiable causes, and understanding them matters more than the price level itself. The first cause is real yields. The 10-year Treasury is sitting around 4.35%. Strip out expected inflation, and real yields are near 2.06%. That number is the one that actually moves gold, and here's why. Gold pays nothing. No coupon, no dividend, no yield. When real yields are low or negative, holding gold costs you almost nothing in opportunity terms. When real yields climb toward 2%, bonds become genuinely competitive. Money moves. Not all at once, not dramatically, but consistently, and in one direction. The second cause is the Fed. The most recent FOMC meeting held the target rate at 3.50 to 3.75%. Powell's language was deliberate. Sticky inflation. Energy price risk tied to Middle East tensions. More progress needed before cuts accelerate. Markets had built in some optimism about easing. Powell quietly removed it. The market now prices in 1, maybe 2 cuts for the rest of 2026. That is not the environment where gold runs. The third cause is the one most people get backwards. CPI came in at 2.4% year over year. PPI hit 3.4%, both hotter than expected. Your instinct, if you've been told gold is an inflation hedge, is probably that this should be good for gold. And over a long enough horizon, persistent inflation is. But here's what actually happened. Hot inflation prints hardened the Fed's stance. That pushed yields up, and higher yields pushed gold down. The inflation was real. But it tightened the very policy environment that would have let gold run further. This is a common misunderstanding worth sitting with. Gold doesn't respond to inflation directly. It responds to the policy environment inflation creates. When inflation forces the Fed to stay restrictive, gold feels it. When inflation erodes the real return on bonds, gold benefits. The same data point can cut both ways depending on the sequence. Right now, it's cutting against. So the correction makes sense. 3 forces, each specific, each with a clear mechanism. It wasn't sentiment, it wasn't panic. It was the market repricing based on a real shift in the rate environment. But here's the thing. Gold is at $4,500. It fell from over $5,000. And it has not broken $4,400. That floor has been tested. It hasn't moved. Something is holding it there, and that something is not retail investors buying the dip. Central banks bought an estimated 1,000 tons of gold in 2023. The trajectory since then hasn't reversed. Forecasts for 2026 point to net purchases near 850 tons. That is sovereign demand, countries diversifying reserves, reducing dollar exposure, treating gold as a Tier 1 asset. This buying happens regardless of price momentum. It's not reactive to headlines. It removes physical metal from the market systematically and continuously, and it creates a demand floor that operates completely independently of what retail sentiment is doing on any given day. Then there's geopolitical risk. U.S. and Israeli strikes on Iranian targets, the possibility of regional escalation, real oil supply risk. Gold's role as the default safe haven asset isn't a narrative, it's a behavioral constant that is repeated across decades of geopolitical stress. When tensions spike, there is a bid. It's not speculative, It's institutional memory encoded in portfolio management. As long as this backdrop persists, that bid reappears every time the price dips toward meaningful support. And the dollar. The DXY is sitting near 99.59, flat to slightly lower in recent sessions. A weaker dollar makes gold cheaper for buyers using other currencies. That's direct demand support. More importantly right now, the dollar is providing no meaningful headwind. One of gold's main suppressors is simply absent from the equation. These three forces, central bank buying, geopolitical risk, a passive dollar, explain why the COMEX tape shows buyers appearing consistently around $4,400. That level is not arbitrary. It's where the structural logic of the market says the risk-reward flips. Now let's look at what the market itself is signaling, because the macro narrative is one layer, and the market structure underneath it is another. COMEX gold inventories as of March 25th stand at roughly 31.95 million ounces. Eligible stocks, the metal actually available for delivery, have seen withdrawals recently. Less metal sitting in warehouses is a tightening signal when demand stays elevated. It's not a fire alarm on its own, but it points in one direction. Options activity is quiet. No large asymmetric bets, no aggressive positioning from institutional players in either direction. This is not bearish. Quiet options markets in the context of a correction usually mean big players aren't convinced the move runs much further, but they're not loading up on longs yet either. It's a wait-and-see profile. That's consistent with everything else. Technically, the $4,400 to $4,500 zone has acted as support. The price is trading below recent VWAP and daily pivot levels, confirming the short-term downtrend is still intact. Volume profile shows buying interest building at $4,400, not distributing. Order flow on dips is mixed but slightly positive, especially when geopolitical headlines cross the wires. Before we go further, what would you personally need to see to feel confident this correction is over? A sustained close above $4,600? A shift in the options market toward aggressive call buying? A Fed signal on cuts? Think about that, because the answer tells you something about your own conviction level, and conviction level should directly determine position size. We'll come back to that. The picture the market is drawing here is a correction within an uptrend, not a trend reversal. Those are structurally different situations, and confusing one for the other is how people get shaken out of good positions at exactly the wrong time. Gold itself is only part of the picture. The miners are acting as an amplifier, and right now, that amplifier is giving a specific signal. GDX, the gold miners ETF, has moved roughly 1.5 to 2 times the percentage change in gold during both the rally and the pullback. That's the deal with miners. Leverage to the underlying metal with all that implies. They outperformed on the way up. They fell harder on the way down. If you held GDX through the correction, you felt more pain than a GLD holder. That's the known cost of the leverage. But here's what the current behavior is actually telling you. GDX didn't break down structurally. It fell in proportion to gold's move and in a manner consistent with a leveraged instrument tracking a correction, not a collapse. If gold stabilizes at $4,400 and begins to recover, GDX moves first and faster. That's the other side of the leverage equation. SIL, silver miners, adds a dimension worth noting. Silver's industrial demand is not sentiment-driven. Solar panels, EVs, electronics, the consumption is structural and the market is in deficit. Some analysts expect modest efficiency gains in silver usage per solar panel through 2026, but overall demand is still outpacing supply. That tightness gives SIL a demand floor that GDX doesn't have in the same way. For a viewer already thinking about precious metals exposure, the instrument question is real. GLD for clean exposure, GDX for leverage to gold's move, SIL for a blend of safe haven and industrial demand dynamics. We've covered why it fell, what's holding it, what the market is saying, and how the related instruments are behaving. Now the only question that actually matters, what do you do with it? First, What's your time horizon? Because the answer to that question changes everything about how to read this setup. If you're thinking in days, this is a different conversation entirely. If you're thinking in months or years, here's how to frame it. Scenario 1. Gold holds $4,400 support. If this level continues to hold and the price stabilizes or begins recovering, the correction looks like a pause within a longer uptrend. The structural case intact, the short-term headwinds real but not dominant. Physical gold, GLD, or GDX exposure on weakness has a reasonable risk-reward profile over a 6 to 18-month window. Central bank buying doesn't stop. Geopolitical risk doesn't disappear. The dollar isn't about to surge. The conditions that drove gold from $1,800 to $5,000 over several years haven't changed. They've just paused. Scenario 2. $4,400 breaks. If support gives way, the next meaningful level is lower. The short-term case weakens materially, and the rational response is either to size down or wait for stabilization before adding. A break of key support in a market that just made a parabolic move can lead to further selling, not because the long-term thesis is wrong, but because momentum works in both directions. Risk management is not a hedge against conviction. It's the thing that lets you stay in the trade long enough for conviction to pay off. Gold can swing 2 to 3% in a single session on a headline. Position sizing and defined stop levels are what separate participating in a trend from being destroyed by the volatility inside it. And the conditions that would actually change the medium-term bullish case? A sustained dollar rally driven by a Fed pivot toward hikes. A meaningful resolution of geopolitical tension that removes the safe haven bid. A structural shift in central bank appetite away from gold accumulation. None of those are likely in the near term, but they're the things to watch, not the daily price move, not the COMEX headline. One last thought. The $5,000 level wasn't the story. Neither is the pullback to $4,500. The real story is that the conditions which drove gold from $1,800 to $5,000 over several years are still in place. The correction is a reset within that story, not a new chapter, not a verdict on the thesis. Whether this moment is the right entry point for you depends on your time horizon, your risk tolerance, and what you're willing to hold through. That's a question only you can answer, but it's worth taking seriously. This video is for educational purposes only and does not constitute financial advice. Everything here is based on publicly available information as of March 26, 2026. Do your own research and make your own decisions.